downside exposure, in fairness. But we may, we're not sitting there being like, okay, technical difficulty.
We are in New York City. It's April 9th, after a slightly boring past 6 days. And we're coming live to talk a little about Q1 performance for J&S Capital and, maybe get into the excitement that's kicked us off with Q2. But maybe if you want to start us off with Q1, a kind of flyover of how we did and sort of start there.
Yeah. So we had a good Q1. We played it somewhat safe. And obviously with Trump as, the new president, we expected that there would be some erratic market movement and a lot of tweets, and he delivered. I mean, it seems like every day there was like a 2 to 3 to 4% intraday movement. And so the strategy we kind of took was, first off, buy the stuff that's already cheap. We entered the quarter with kind of a bifurcated market. We've been talking about it for years. We've got a certain subsection of the market, namely large cap growth stocks and really anything in the S&P 500 index or the NASDAQ 100 index that was trading at historically high and historically unsustainable valuations. Yep. You had another subset of the market that was sort of trading roughly in line with where you might expect it to be trading, and then you had another subset of the market that was, for whatever reason, quite cheap. So our strategy is obviously not to buy those expensive stocks and expect that our return will come from historically expensive valuations getting even more expensive. That's playing musical chairs. That's not our game. So we were buying companies for tiny fractions of tangible book value that maybe had slightly depressed cash flow for a temporary period, so long as we had a nice view towards when that they may experience an inflection in that cash flow, and then that would allow us to realize the value of that asset base. We bought a lot of special situations that weren't necessarily correlated to the market, like, for instance, shell companies that were being liquidated after selling their business operations, and the thesis is basically we buy it today, we're buying it for half of cash, they have wind down costs, in 5 months we get a distribution, doesn't matter what the market does. So we like those types of plays, at least when the market is hot, because, as ended up being the case, and as we are always aware of, at any point the market can crash, especially when it's running hot. So we want to have opportunities that we're going to make money regardless of whether the market goes up and down. And what that means is sometimes if the market just keeps going up, maybe we lag a little bit, but when the market goes down, we're still going to make money, yeah. Right? So we did a lot of those. We hedged our portfolio a little bit. We had, an electronic market making firm that benefits from extreme volatility. That's when they actually make a ton of money. And so that served as kind of like a little hedge against market volatility and served us very well during Q1.
So Q1 we ended plus 3.
Like 3.8, I think. I think 3.8. Market was down 4.5% on the S&P, quite a bit more on the NASDAQ, quite a bit more than that on the Russell 2000. Yep. So all in all, I mean, U.S. market's down. Yep. And again, our idea going into this too was Trump has been very, very transparent about the fact that he wants to devalue the dollar. Yep. So we had a little bit more euro exposure. And by euro exposure, we don't mean we speculated on the euro specifically, but we bought a lot of cheap European companies with the idea that as Trump devalues the dollar, which he has done so far, that all of those companies would benefit just by nature of having all of their cash reserves in euros, earning euros. It's so naturally we kind of get, one, a cheap company, and two, we kind of get that inherent dollar hedge in there. Yep. And two, we actually, which is very abnormal for us and for me, I've actually not done this very often in my career, but we bought gold as a hedge against devaluation of the dollar. So that buoyed our portfolio as well. So that was why we were actually able to turn a positive Q1 where the rest of the market didn't perform so well. We still own We still own all of those cheap U.S. companies that we love to have as our base of our portfolio, but we had enough bets that offset the decline in the U.S. markets to help us get through Q1. Q2, I started with Liberation Day, which, for a while seemed like really what he was doing was liberating us from our capital. And so the market tanked. We saw massive leverage unwind, margin calls left and right. So what you saw was just indiscriminate selling across global markets, actually, not even just U.S. markets, across global markets. And that actually presents really unique opportunities for us. Because entering the quarter, we still had sort of that same bifurcation of the market where you've got expensive stocks, you've got cheap stocks, and you've got stocks that are in between. And so the expensive stocks sold off, but also because of the whole dynamic with the margin calls, everything was being sold indiscriminately, irrespective of price. Whatever could be sold was being liquidated by the prime brokers, by the hedge funds, And so what that meant was a lot of the stocks that were already, quite cheap, beforehand, now they are just presenting absolutely crazy entry prices. I mean, one of the examples I've been throwing around lately is that hotel stocks right now, hotel REITs, they are in many cases cheaper than during the beginning of COVID, when there were nobody in the hotels, when occupancy was quite literally zero, and we thought it might be years before anybody would even stay in a hotel again.
That conceptually is
crazy.
Insanity.
It makes no sense. Yeah. And so that's just kind of an example of wow, that things have really gotten crazy. So obviously, we're digging through the stocks that were cheap a week and a half ago that are now 30% cheaper.
Yeah.
And that's where we're playing. So we don't know how long this tariff environment is going to last. Quite frankly, anybody who says they do, whose name isn't Donald Trump or who isn't in his administration, I would say is probably making something up. But the names that we are in, once this environment is over, we will see some pretty strong appreciation. And we're actually filming this right after, right on our first big up day after Trump decided to pause tariffs on everybody except China. And we saw a huge market rally in short covering, and a lot of those names that we bought are, they're up 25% in one day. So I don't think we're in the clear yet. I think anybody who is expecting the next really 3 years to be anything other than volatile probably needs a reality check. Mm-hmm. But it is going to present a lot of very interesting opportunities. Yes. This is where you can make a lot of money, and I would expect that even if the indexes as a whole continue to decline, which they very well might. I mean, we are still at a very historically high valuation. We are at a valuation that has never previously been sustained over a long period of time.
And even prior to today, the after there was Thursday, Friday were brutal, but even before this, shift in announcement, the 90-day pause, even after being down 20%, the valuations were still
very high.
Still the highest times we've ever seen.
Yeah, it's yeah. So that's not a that's not something that I think will be remedied solely because Trump paused tariffs on everybody except China. I also expect that China is a fairly large economy, and this continued trade war for however long it lasts with China is almost certainly going to cause a lot of problems. And so I don't necessarily think we're I don't think we're in the clear yet necessarily, but I think that there are some amazing opportunities to be taking advantage of right now.
Yeah. One of the things that we've talked about before is the magic isn't necessarily in the somebody drafting a strong investment thesis. Like a lot of people do that. It really comes to the execution, and the times when execution is tested the most and discipline's tested the most is in these volatile periods. So how do you stay composed and disciplined in these kind of times, because this is, and you've seen it from all the great investors where like, it's not like they necessarily learn something from these type of areas. It's more of like continued reinforcement of just stay focused and disciplined on what the strategy is. So yeah, what do you do? How do you stay disciplined with it?
So a lot of people, I mean, you're right. It's a lot of managing emotions, right? It's managing the fear. It's managing the uncertainty. It's, every investor I've ever talked to can tell me a story about, a time when they either literally vomited or they felt like they were going to vomit because of the market activity. So anybody who says they don't feel those emotions, I'm pretty skeptical of.
Yeah.
So it's not, it's not as if, when the market's down 6% 3 days in a row, it's not like we're sitting there happy necessarily, but it's about seeing the bigger picture, right? So in the way that we try to do that is we're not thinking, okay, where is the market going to be tomorrow?
Yep.
What is this stock going to trade at tomorrow? What we're trying to do is we're trying to say, okay, where is this stock going to trade 18 months from now, 3 years from now? Because at the end of the day, we could buy something, it could be down 20% more tomorrow. But if we think that 18 months from now, once all is said and done, once we're, presumably out of this tariff war, and we can get a reasonable estimate of what earnings might look like, then, that's how we think about things. Where is it going to be 18 months from now? And that kind of enables you to hold through all of the volatility and really add when you need to be adding. I think the problem a lot of people have is when they see the market going down 6, 7, 8% in a day or multiple days in a row, they just panic and they're like, I don't want to take the pain anymore. I just want to get out. And that's when, that's when the market moves up on you 10% a day and you've missed the entire ride.
Yeah.
So really how we think about it instead is we're just constantly trying to upgrade our portfolio, right? So as the market tanks, we're not necessarily selling and we're not necessarily adding exposure. We did add exposure in fairness, but we may, we're not sitting there being like, okay, technical difficulty.
We're back.
So I think where we were talking about how as the market declines, a lot of people panic sell. And that's because they don't want to take the pain anymore. That's because they think that if the market can fall 20%, it can fall 40%, and they get out and they're just hoping that the market keeps crashing. And in our view, that's kind of, that's how you end up missing, the move on the opposite end, because the most violent positive reactions are also going to be when things turn at the bottom. So if you miss those first couple days, like you are in trouble. So really, how we think about it more is we want to hedge our portfolio. So we have positions that are not only not correlated to the market, or we have positions that are inversely correlated to the market. So for instance, they benefit from market volatility, and that serves as a buffer on the market decline. But also, as the market falls further and further, you get larger and larger price dislocations. And there's not a lot of rhyme or reason when the market's crashing, right? It's more like people are just selling whatever they can. And so what often happens is you get some of the less liquid companies and the smaller companies will trade off significantly more than the larger companies. So what we can do is, as every day as the market keeps crashing, we can go through and the relative value of every stock in the market changes, right? Because at the end of the day, it's a relative value equation, right? Like something can be extremely cheap, but if something is cheaper, you should buy the thing that's cheaper. So we're going through all of our positions, we're going through the entire market, and we're saying, hey, what's changed today? How do our positions stack up against the rest of the market? So we always think our stuff, we always think the companies we're invested in are cheap. Otherwise we wouldn't be in them, right? But we're evaluating to see if there's something out there that we know about that has suddenly become cheaper due to the volatility. So the way that we think about it it's not that we are buying or selling necessarily, as part of the crash, but it is we are constantly upgrading our portfolio. So in theory, our portfolio keeps getting better over time. Today, our portfolio should be worse than tomorrow, should be worse than the next day, should be worse than the next day. So every single day, to a degree, our portfolio should be getting better, and that is especially exemplified during market crashes, when we can really start loading up on the stuff that has become, much more dislocated from the price that they theoretically should be trading at. So that's how we've been handling the market decline. Obviously, we've taken a hit. I mean, we're a net long fund. So yes, we have experienced some decline, not even remotely close to what the market has. And our portfolio has gotten significantly better. And honestly, I think we are in a very, very good position. And I think that we're set up for a pretty good 2025 and 2026, assuming that at some point this tariff and trade war thing does blow, which in our minds it has to at some point, right? Like you can't keep this up forever.
Love it. Good.